Pause whatever you're doing for a second and lean in. If you watch markets even casually, something just happened that you don't see very often, and it's unfolding in real time. Silver didn't just move up today, it ripped higher in a matter of hours, blowing through levels most people thought were years away. Western spot prices surged past $121, while China just printed silver futures at $146.17. That's not a typo. That's a $26 premium right now, between East and West. And when you see that kind of spread open this fast, it's telling you something important. Stay with me, because I'm going to show you why this isn't just a price spike, and how you can spot this kind of stress before it hits headlines. If you're holding silver right now, your job is to understand what's actually driving this move. If you're watching from the sidelines, you're about to learn how to recognize when markets are screaming something that most people miss until it's too late. Before I explain what caused this move, let me teach you something most people never really learn about metals markets. There are effectively two silver markets running at the same time. One is paper. That's futures, options, ETFs, leverage on leverage. The other is physical. That's bars, coins, refinery output, vault inventory. Most of the time they move together, close enough that nobody questions it. The paper price goes up, physical follows. Physical gets tight, paper reflects it. It works. But when physical demand overwhelms supply, those two markets start drifting apart. And this is important, so stay with me here. Think of it like airline tickets versus actual seats. You can trade the ticket price all day, derivatives on derivatives, hedge it, leverage it, whatever. But if the plane is full, suddenly the real value is whatever someone will pay to get on board. Not what the screen says, what someone will actually pay when they need that seat. That's the moment we're flirting with right now. The paper market is quoting one price, and the physical market is telling you something completely different. And when you see that divergence hit $26 in a single session, you're watching stress in real time. If this is making sense, drop a comment below and let me know if you've been watching this develop. Now here's what's actually happening. Let me break down the sequence because this isn't random chaos, it's mechanical. The primary driver is physical scarcity, and I mean real scarcity, not theoretical shortage talk. Global silver supply has been in a structural deficit for years. Inventories didn't magically refill. They quietly drained, and most people didn't notice because it happened slowly, then suddenly. Solar demand kept rising. Every panel needs silver paste. Tech demand kept rising. Electronics, semiconductors, all of it. Then investment demand came roaring back. People started stacking again. And here's where it gets interesting. Refiners started hitting limits. Major players like the Perth Mint and Metalor, these aren't small operations. They paused or restricted new orders. Why? Because sourcing raw silver became a real problem, not a theoretical one. When refiners can't get enough material to keep up with orders, that's not speculation. That's supply chain failure in slow motion. Now, secondary confirmation showed up in vault data and delivery behavior. This is the validation layer that most people ignore. Western exchanges still quote paper prices. You can pull up a chart right now and see $121. But more contracts are standing for delivery. More metal is leaving vaults than entering. Go look at COMEX data yourself. You'll see registered inventory dropping week after week. And when people start asking for physical settlement instead of rolling contracts forward, that tells you confidence in paper pricing is cracking. They don't trust the screen anymore. They want the metal in hand. Then comes the convergence point, and this is the part most people miss entirely. China doesn't care about Western paper pricing when its domestic demand is tight. The Shanghai market reflects physical reality faster because it's closer to actual consumption and manufacturing. And when you see Shanghai futures trading $20, $25, now over $26 above Western spot, it's not arbitrage noise. It's not a pricing error. It's stress. It's the market saying, if you want metal delivered in Shanghai, you're going to pay what it actually costs to get it there, not what a futures exchange in New York says it should cost. And that stress exposes something uncomfortable. The paper price isn't setting the market anymore. It's reacting to it. The tail is wagging the dog. But here's the part that should make you nervous if you're not paying attention. This decoupling doesn't close gently. It never does. It closes violently, usually with margin hikes, delivery delays, or forced repricing. When banks and clearing members on venues like the COMEX start scrambling for physical settlement, the game changes fast. Price becomes less about charts and technicals and more about availability. Can you get metal? How fast? At what premium? Those questions start mattering more than support and resistance levels. And when that shift happens, moves go vertical because there's no liquidity in physical panic. This isn't uncharted territory either. Zoom out for a second. We've seen versions of this movie before, and the script rhymes every single time. In the late 1970s and into the 1980s spike, physical demand overwhelmed paper controls and silver went vertical. I'm talking from under $6 to $50 in less than 2 years. Why? Because the Hunt brothers and global investors flooded into physical metal, refiners couldn't keep up, and premiums exploded. The paper market tried to contain it with margin hikes, and eventually it worked, but not before silver hit levels nobody thought possible. Same pattern: physical stress, paper denial, then violent repricing. In 2011, ETF inflows and tight inventories pushed silver near $50 before margin rules slammed the brakes. That wasn't manipulation in the conspiracy sense. It was exchanges protecting themselves from delivery failures. But before they stepped in, you had the exact same signals: premiums rising, inventories falling, backwardation showing up, and then, boom, silver doubled in 6 months. Same movie, different decade. And more recently, during the early 2020 supply disruptions, premiums exploded even when spot prices lagged. Remember that? Spot silver was trading at $18, but you couldn't buy a physical ounce for less than $30 in some cases. Why? Because refineries shut down during lockdowns, mints couldn't produce, and demand spiked. The paper market said one thing, the physical market said another. Every time you see sustained backwardation, rising premiums, and shrinking inventories at the same time, the pattern is the same. The paper market is living in yesterday's reality, while the physical market is pricing tomorrow's shortage today. The larger story isn't speculation. It's structural imbalance that eventually forces repricing. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this reverse? Of course. Markets don't move in straight lines. Could exchanges raise margins tomorrow and flush out leveraged players? Absolutely. They've done it before, they'll do it again. Could governments or large institutions intervene to cool things off? That's always on the table. Central banks have silver reserves. They could lease metal into the market. Regulators could change rules. There are a lot of ways this could get managed back down. But here's the thing about manipulation narratives and conspiracy theories. They don't help you act. They don't give you a framework. What helps is watching what can't be faked. Delivery volumes, those are public. Premiums, you can verify those across dealers. Refinery output, that's reported. Inventory drawdowns, you can track those on exchange websites. Focus on what you can verify, not what makes for a dramatic headline. The mechanics are what matter. You can debate motives all day, but the data is the data. There are probably 3 types of people watching this right now. Maybe you're the long-term investor who already owns silver. You've been stacking for years. You believed in the thesis when silver was at $15, at $20, at $25, and you held through the noise, and you're sitting here wondering, is this the moment? Should I panic? Should I celebrate? Should I sell? Here's what I'd tell you. The move validates the thesis. You were right to hold. But it also means risk management matters more than ever now. Don't ignore volatility just because you're up. If silver can move $30 in a day on the upside, it can move $30 on the downside. Have a plan. Know your exits. Don't let euphoria replace discipline. You didn't stack to panic sell at the top or hold through a full reversal. Think in ranges, not absolutes. Maybe you're a trader who feels like you missed it and you're tempted to chase price. I get it, I really do. FOMO is real, and watching something rip higher without you on board is painful. But chasing vertical moves is how accounts get wrecked. You know that. Silver's not going to go straight up forever. It'll consolidate, it'll pull back, and when it does, you'll get structure again. Wait for that. Wait for a retest of support. Wait for a pullback that holds. Let the market show you its next breath. Don't chase the candle that's already burned. Or maybe you're just trying to understand why silver suddenly matters again. You're not invested, you're not trading it, but you saw the headlines and you wanted to understand what's actually happening. For you, this is the lesson. Markets whisper before they scream, and premiums are whispers most people ignore. By the time it's on CNBC or trending on Twitter, the smart money already moved. The edge is in seeing the setup, not reacting to the move. And the setup here was months in the making. Inventory drawdowns, refinery restrictions, rising premiums in Asia. All of that was visible if you were watching. So here's what I want you to answer in the comments. What pattern or signal do you watch to spot stress before it goes mainstream? Because that's the skill that separates people who catch moves from people who chase them. So here's where I stand. I'm not euphoric and I'm not dismissive. I'm focused. Let me tell you what I'm personally watching. First, I'm watching physical premiums, especially in Asia, because that's where stress shows up first. If Shanghai premiums stay elevated or widen further, that's confirmation this isn't just a one-day spike. It means the underlying tightness is real and persistent. Second, I'm watching delivery data and vault inventories, because paper lies and metal doesn't. If registered COMEX inventory keeps dropping and deliveries keep rising, the pressure is building. If that reverses and metal starts flowing back into vaults, then maybe this was just a short squeeze. Third, I'm monitoring policy responses. Margin changes, trading halts, any exchange intervention. Those are signals that institutions are worried about delivery failures. And fourth, I'm tracking refinery updates. If Perth Mint or others lift restrictions and start taking orders again, that eases the physical bottleneck. If they don't, or if more refiners follow their lead, the problem gets worse. Based on my analysis, this move was mechanical, not speculative. It wasn't driven by Reddit hype or short squeeze narratives. It was driven by physical shortage meeting real demand. The fundamental picture hasn't changed. The supply deficit is still there. Solar demand isn't going away. Industrial demand isn't collapsing. And investment demand is just waking up. Those fundamentals are asserting themselves against a paper market that's been suppressing price discovery for years. And when fundamentals assert themselves, the moves are bigger and faster than anyone expects because the market has to reprice everything all at once. If history rhymes and physical silver tightness persists, the move that follows could make today look like the opening act. I'm not predicting a number. I don't do that. But the pattern says when you get this kind of dislocation between paper and physical, when you get this kind of premium divergence between East and West, the market is resetting what silver is actually worth in a world where you can't just print more of it. And that reset doesn't happen quietly. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word or anyone else's word. Build your own conviction based on facts you can confirm. That's how you make good decisions. Not by following someone else's excitement, but by understanding the structure yourself. If you made it this far, you're thinking deeper than 99% of people watching markets right now. That mentality will serve you well. Share this with someone who needs to understand what's actually happening. Subscribe if you want more analysis like this, and stay ahead of the noise by focusing on signals that matter. Stay sharp out there.